Welcome to the Infinite Mindset Podcast, the show where we explore the power of the infinite banking concept and how to take control of your financial future. I'm your host, Andy, along with Scott and frequent guest Jared. We're here to help you think bigger, build smarter, and create freedom on your own terms. Let's get started. All right, welcome everyone to another episode of the Infinite Mindset Podcast. We're going to start off recognizing our brothers and sisters over at UPS in Flight 2976. They're going through a tough time right now. The whole aviation community is, so prayers to everyone out there dealing with this right now.
Yeah, not easy. Big community turns small when something like that happens, right? Just offering assistance in any way we can and just keeping those folks in mind. It's hard time, no question.
There's people on the ground too, lives lost there and people injured, just off the airport property.
Yeah. All right. I don't think there's a way to do a smooth transition there, but Scott, what's going on with you right now with the practitioner course?
Tough one. Yeah, I took a couple of the practice tests on my last trip, my last 4-day. Scores are good on the life insurance side, but Wisconsin ties in life and health insurances together, and then you do a general test. So you got your general test and then life and health tied together. But anyhow, like 95% on life insurance and 70, 80 on health. But I guess, like I said before, the best way I can relate it to is college and high school. You go to school for something that you want to do, and your scores are significantly better. But to that point, though, I'm just going to get the test scheduled and go take it. I think it'll average out, but it'll be a passing score. And that gets me into the college level, Nelson Nash Institute, get that process rolling, and get into something that I actually, want to focus on. Kind of goes back to like our last podcast about agents and practitioners. So it's like I'm not
Like the private pilot course, right?
Insurance.
You just got to, that's your license to learn. You just got to dive in and check some of those boxes, and it's the license to learn.
It's a good way to put that. Just get it done.
Yep. Yeah. All right, cool. Hopefully next time when we meet up, that will be done and we're moving on and we're talking about upcoming interviews and stuff like that with the NNI.
Right.
Cool. All right. So in this podcast, we're going to talk about premium. We often get questions from clients or others out there. What is the right amount? And so we're going to burst your bubble here a little bit, but bottom line, it depends. We're not going to give you an answer right down to the penny. And you're also not going to solve your need for finance with that first policy. It's going to take a series of policies. Nelson used to talk about it would take 20 years to slay all the snakes and dragons, meaning getting rid of outside finance and bringing all of that into your own personal system. It's also impossible to predict everything that's out there and all of your needs. And you're probably not going to have enough capital unless you're uber wealthy to actually solve all your needs for finance with that first policy. When you look at the initial setup and getting it going, it usually takes multiple policies to get there. And there are going to be things that are going to allow you to expand as you go later on as well, whether it's inflation, windfalls, promotions, or potentially unexpected things as well, good and bad out there that may affect different things that are going on. But the key in any of these, whether it's your first policy or we're 15, 20 policies deep, it needs to be sustainable based on your current outlook. So working with a practitioner, we're going to pull all the data together. We're going to get a really good feel for where you're at and what's going on in life, and we're going to come up with a plan. But ultimately, you are going to be the one that decides on what is best for you. We're just going to kind of give you some guidance going through. We'll also have some exits, and we'll have contingencies for worst case scenarios to make sure that we're not putting you into a rough place. And this next part, I don't want to dive deep into it too much, but I want to talk a little bit just about premium so people kind of understand. For today's talk, when we talk premium, we're including everything. And what I mean by that is we have base, which all policies have. That's a requirement when we're referring to whole life. And then everything else is going to be a rider, whether we're talking PUA, whether we're talking about extra convertible term, waiver premium, OPI, whatever it is. But the ones that we typically focus on are that base to PUA ratio. And that's going to be based on many factors, whether it's age, liquidity needs, insurance needs, etc. And with that, we talk about it, and I'm sure, Jared, you do the same thing. I do a very deep rundown with my clients to make sure that, hey, especially when we're talking waiver premium, not to get it. Worst case, if things go terrible, what do I need to do to keep this policy in force and make it so that it's still an asset and not a liability?
Yeah, well said. I mean, maybe just to back up to one of the first things you said, just to highlight the book that's the the basis for all of this is Nelson Nash is becoming your own banker. We've said that before. We have to highlight that again. That's the Bible for starting this course. Yet it's called becoming your own banker. It's not called becoming your own small lien holder, becoming your own, fill in the blank, right? It's becoming your own banker. Those banks just don't show up, drop $10 million on the table and start doing business. It takes years and years to build the assets up to where they're not only, taking deposits and making them go to work, So I guess kind of I want to highlight what you're saying and reinforce what you're saying, that this is years and years worth of system. This is a long play. This is a looking into the multi-generational type of a play, as well as your need for finance in your family is right now. So there are living benefits of these policies right now, but there's a multi-generational thought process that will take place. And that's where we want to get to know you. We want to see where your thought process is, where some of your money goes right now, where do you use it, how do you spend it, what are your thought processes? And that's the whole goal of getting to know your practitioner. It's us interviewing you as much as you're interviewing us. So loved what you said there, and I like how simple you keep it with just, it's base and then everything else. We could do a whole nother episode, or one we've already done on what that looks like in the weeds. I love how you started with that. Super, super important.
Scott, anything you want to add, buddy?
No, I think we're just kind of looking at the next bullet point. It goes back to, in regards to premium, meaningful and manageable. So, but we'll get to that. But yeah, in regards to everything else, it's just, I guess, having policies that aren't properly structured from way back in the early 2000s to policies now that are properly structured. It just goes back to the practitioner thing, getting to know somebody, making sure they understand what your goals are, and going forward, and then they'll help you with what we'll talk about next, the meaningful and manageable part.
Cool. And then, yeah, we'll jump on that. That's a perfect lead in there, Scott. But one thing I do want to circle back to, because I think it's important when we talk about these worst case scenarios, or if something does something does pop up, realize we are always here to help you. It's not like we're selling these policies and we're going away. I still talk to all my clients. And so if something does pop up, the sooner you reach out to us so that we can help you, the more options we're going to have to help. We'll still help even if you wait to get us later on. The problem is that some of our hands may be tied a little bit more if things get so drastic. So if anything pops up and you're concerned at all, pick up that phone and call, and we will make sure that you're good to go. But to your point, Scott, yeah, that was spot on. So when we build these things, we want to make sure that they're sustainable and worthwhile. And the two words that I always use, and Scott, you hit on them already, are meaningful and manageable. And really what I'm getting out there, meaningful is, are you paying enough premium that this is actually going to make a difference in your life? Or is it so minuscule that it's not even worth your time, right? And the other part is manageable. And we've talked about this before. We have a spectrum. I have some clients that come in that are really hesitant to commit very much to this. And I have other clients that see it and they are gangbusters. They want to go all in, and I'm actually pulling them back. And that's the manageable side of it. We can get there, we can expand the policies, but let it happen organically. Don't try and force this or rush it and put it into a point where you're struggling. And we can get into some of the structure and how we build it. If you go to that manageable side and you're pushing it, what I don't want you doing is paying for extra stuff and you're not using it, i.e. extra terms so you can put more PUA in, but now you're just having extra expense that isn't working for you. And I don't want to get too into the weeds on it, but that's kind of the mindset that I'm thinking there. And I will say, with that meaningful and manageable, everybody wants a specific number. I don't really like going down that road because everybody's situation is different, but I will go percentages to a degree to kind of talk to people. And usually it's at 10 to 30%. So 10% for most people is going to be meaningful. It may be a little bit less than that. We'll have some clients that are starting out, they're seeing this early on in life, or there's some kind of financial struggle even if they're later on, and they'll just start with convertible term because they're not there yet. I totally get it. We're saying everything being equal, this is kind of what we're looking at. And I realize everybody's situation is different. 30% is the far end of it, which is the very top end. Some people are saving that much. And then what we actually start running into is how much will the life insurance company actually underwrite you for? And it depends on your age, and it'll be a multiple of your income at that point. And once again, I don't want to get into the weeds, but that's kind of the broad spectrum that we're getting at. But what I find really interesting, and coming back to the book, Becoming Your Own Banker, and Nelson hits on it, most people struggle to even save 5%. And that was when Nelson came out with this in the early 2000s. It's even worse now from what I've been reading. I think people are, they're really struggling to make ends meet. So even just saving it all can be very difficult. But depending on who you are and what's going on, you're saving. we will work with whatever client we have. So some clients are, hey, I've got it. I know this is the amount that I want to put. Great. We'll kind of be hands off. Other people come in and they just kind of throw everything on the table, and it's help me at this point. Where can I find cash? What's going on? So like I said, we're flexible, and then you want to find the practitioner that you're comfortable with as well to explain this properly and make sure that you have a good plan going forward.
Yeah, something to add there real quick. If kind of the disclaimer on this story is if you talk with anybody that's working with a practitioner that's 1 year and beyond into working in infinite banking, they are excited to pay premium. Once you realize what you've unlocked, how it works, and how easy it really is, they are excited. They'll do an annual pay. They can't wait for that bill. I say bill. They can't wait for that time to come due when they get to pay their next year's premium. How crazy is that? Because when you first look at this, it looks like a cost. It's not. It is for lack of better words, a forced savings vehicle on some folks at the very beginning. If you look at it that way, it changes your mindset on it. And then when you get 1+ years beyond and you're looking at this, you get excited when you get to pay into that premium and unlock even more features of what you've built. So I only say that as someone that's been on both sides of that. When you're on one side and you've maybe just read the book and you're still trying to figure it out, I guess I'm just trying to empathize and say I've been there. I understand what that looks like. I passed way longer than I should have. I let this go for 10 years before I took action on it. And now that I have, God, I wish I would have started earlier. But that's what everybody says, right? And so, when you talk to someone that's working with a practitioner and is established in IBC, they get excited to pay the premium. So it's just a complete change in mindset.
Yeah, Nelson always used to say, you catch it, right? You can't teach this. So I'm not going to convince somebody to do this and people catch it right away, or they never catch it, or they catch it at some point in the middle. But the key is you have to catch it. If you're going to this with long teeth or uncomfortable, let's take a pause, we'll take a knee, and we'll figure out what's going on, because our goal is not to force you to do something that you're not comfortable with.
100%.
Oh, sorry. No, the best time of year is policy premium days. It's it's pretty cool watching the numbers grow, watching everything happen, and most of the time you're in the what do they call it, the non-guaranteed column. So you're getting up there. Dividends getting declared. But I just saw you had a post 121 years with the company you're working with of declared dividends.
Their dividends for 121 years,
cool.
and they just upped it from last year.
100. Yeah, that's pretty sweet. And like I said, you get into that non-guaranteed column, then so just better performance, better growth.
Yeah, I will say when you look at the life insurance industry, we're hitting on this now. So I write for the same company that Scott and Jared, you guys are both talking about. And then my other company that I write with as well, I just had a meeting with my regional rep on Monday, and he was talking about the dividends that they're paying as well. And I will tell you, it's impressive. These companies are very conservative, but they're doing very well. And so it's a very good place to store your capital.
Great.
Yeah, I was going to say, back to like the numbers, in regards to premium, just it doesn't have to be what you're saving either. You can, sequence money through a policy before it goes to doing whatever it's going to do. That frees up money for the policy because it's already headed someplace else anyway. It doesn't necessarily have to be into your savings account.
Very well said.
Exactly. And the other thing is, John, obviously we're getting excited here. And so when we get excited, we start, thinking about ways we can expand the system. And so dovetailing into that a little bit is that there's a couple ways to do it, right? So the two that I think of primarily are convertible term or other insurable interest, or actually a third way, just while we're thinking now, is the OPI, right? The option to purchase additional insurance when we're talking about juveniles. So once you start off with that first policy, and we've seen it before where some people start too small and within 6 months later, they're back and doing another one. Other people, it's going to take a little while. Other people maybe got a little bit too big initially, and then they're trying to figure out how to make more work, or maybe there's something that changed in life. But ultimately, what we see with, I don't know exact number, but a overwhelming majority of our clients is they do want to come back and expand once they actually understand it, like you're saying, especially when they start seeing these things multiple years in and what they're doing. The typical regret is either not starting soon enough or not starting big enough when they're getting going. But
or
once
both.
Again, hindsight's 2020. Yeah, hindsight is 2020, and it's tough. You got to think about how long we've been on this journey, and if you go back to the beginning and what your mindset was, it changes, right? This is all about rethinking your thinking. So
When I actually got a properly structured policy, that's exactly I didn't. I held myself back, and then 6 months later, I was already expanding, and did the policy for my daughter to make up for what I throttled back on. So, been there.
So there's probably some people out there right now listening to us and they're going, these guys are crazy. What are they talking about? And so I'm referring to somebody that's either new to IBC or they're struggling to understand it, but they're trying to wrap their head around it. So I think if we start with a little bit of modern financial guidance and the way most people are taught, and then talk about how we're thinking about things through IBC, that might help a little bit. So if you think about now with what most people are taught, you're taught to pay all of your bills and expenses, take whatever's left over, and then put that into kind of some tax sheltered vehicle that is typically high risk to get high rewards, right? That's what we're taught, high risk, high rewards. I'm opposite of that. I'm very low risk and kind of steady and then building from there, but I want a bigger volume. And so with these other people, they're hoping that little sliver that they're putting in is going to be able to get them through their passive income years. And then when they do get to those passive income years, often they're kind of, you just, that 4% is what it is they can take out. And that's what they're doing to try and sustain, to make sure they don't build or burn through all their principal. And so we're doing the complete opposite, right? We're actually going to pay ourselves first through premium, and we're going to get a high volume of capital that's in an extremely secure place. And this is key. We're actually transferring the risk to the insurance company and locking in everything that we can. So I said it already, but it's really important. Nelson used the same term. You need to rethink your thinking. And by doing that, we're conquering inflation, taxes, opportunity costs, and all the money that is flowing out of our system. And we're not just choosing one path. This is an and asset. This is just the first place before we're doing everything else that we're doing. And so what we're doing by doing that is we're capturing what the banks are capturing. And if you want to look at one of the illustrations, understand what we're talking about, it's the interest and the dividends, or the guaranteed and non-guaranteed side when you're looking at the illustration. And so we're capturing all that regardless if we're accessing the capital or not, which is huge. So you have that true uninterrupted compound growth. And so for us, instead of worrying about that small little sliver of savings, we're actually thinking about a larger volume of money. And this is huge. I'm going to say this a couple of times. Premium is the solution. Premium is the solution. Okay. If we get premium high enough, then we can conquer all those things, the taxes, inflation, opportunity costs, and the money flowing away. And we're setting ourselves up for success, especially long-term and for follow-on generations. And this is really important. The only way to increase the cash value is through premium. And I want to bring this up because there's a lot of confusion when people read the book or they hear stuff on the internet. They think that loans are increasing their cash value. They're not. By taking a loan and paying it back, all you're doing is replenishing your cash value. The only way to increase the premium, your cash value, is through premium. And why? Because premium buys death benefit, and that can be base premium, it could be PUA premium, or it could be dividends that are being used to buy additional PUA premium as well. But I just want to clear that up because I think that leads to a lot of confusion, and that's why we say premium is the solution, because it's the only thing increasing the death benefit. And then cash value has to equal death benefit at age 121 here in the US. So that's what we're trying to do.
Really agree. Really well said. And maybe just add a different terminology to it. Your cash value, and I say cash value because it's a number that's on the account, right? It's not cash. It's a cash value. That's your net present value of a future death benefit. So when Andy says, "Hey, you've got to increase your death benefit in order to increase your cash value," he is spot on. But that's just kind of a different way of saying, these are the kind of portals of which you have to open up and unlock some of your infinite options that you are creating. It's just how big that pile is, basically, is what he's talking about.
I think the other thing too is we can compare this to a couple other things, because sometimes people are still stuck. And I know we're going to say what we just said, and people are still going to go, that eyebrow's going to raise. They're trying to figure it out. So maybe if we compare it to some other things that they're familiar with, it might help kind of unlock what we're talking about as well. And so the first thing we'll look at is corporations, right? If you look at what you're told to do versus what a corporation does, it's very different. Corporations are going to focus on cash flows and guarantees, exactly like what we do with their life insurance policies, and they're going to pay themselves first. They pay themselves first differently. We do it through premium is how we look at it. But this is very different than what we talked about with conventional modern finance. And if you can think of premium the same way that corporations are paying themselves first, I think it's going to help you kind of wrap your head around that a little bit. And then I want to circle back to this. I know we touched on it a little bit, but I think it's really important, the whole asset versus liability. A lot of times when people hear insurance, life insurance, whatever it is, they're thinking almost like an auto policy or a term life insurance type thing, and it just becomes an expense that they dread every month. If you look at this as an asset that you're building that's just going to continue to grow and grow and grow upon himself, it's very different. And we get excited about that annual premium that we talked about. And another way to kind of look at this is if you're building equity, just like you're building equity in a home, right? Every time you make that mortgage payment, you now have access to more. But there are some really big key differences here. I just use the home because it's easy for people to kind of wrap their head around it, thinking about a HELOC. But the key difference here is you've transferred risk, unlike with the home. And I think about the '08 housing bubble when everything blew up, right? We are guaranteed to grow. Every time you get a dividend, every time you pay premium, you ratchet up and it's never going to ratchet down. Your policy can only grow at that point, unlike the equity in a home where all of a sudden you can be underwater, right? We're also extremely liquid, unlike a home where it can be difficult to access that cash, right? If you've ever gone to apply for a loan, if your credit's bad, or maybe the market's gone upside down, or maybe you just have too big of a mortgage and you can't get that HELOC on the backside, it can be very tough to access that capital. So you don't need any kind of permission. And the other thing is it's unstructured, right? So we always want to be a disciplined banker and a good steward of our money and pay back those loans. But if there is a difficult time, nobody's knocking at the door. We're good to go. We can take that period to get ourselves and our heads back above water before we have to pay back that loan. And this is why it's such a powerful asset and why Nelson Nash refers to it as his wealth warehouse, because capital has to reside somewhere. Well, better place than here. And that's what he means by that.
Yeah, maybe to bring a real world example to that during, the COVID crisis, as they're starting to reemerge and everything's going on. And I think it was mid 2020. I don't know how well you remember this, but they shut down the ability to go get a HELOC. All the banks stopped offering that. And I had a close friend that had done all the things right. He did great on paying his house down, paid the extra, paid it ahead of time. And now he's got all of his, net worth, not all of it, but he's got some serious net worth locked into his house. Hey, great. A lot of folks do that. And yet at that time when he needed it, when his job wasn't rolling like it needed to be and he needed to go access some capital, he couldn't get it. They shut down his ability to go get a HELOC of the asset that he owns. Long story short, multi-years later, he's now a client. And I'm excited that he's building something for him and something that can be accessible and used from creating his warehouse of wealth. So, that's just a real world story. That's one person. It's just, if that helps someone understand it a little better, that was what I got to see firsthand.
I can think of a friend that was in a similar situation as well. They're doing very well now. They're a client now as well, ironically. I think for other people that are listening, the goal would be that you don't get yourself into a position that you're in a hardship before you come do this, to try and figure out if this is the way to operate. Yep. If you can get this in place ahead of time, then there's going to be a hardship, right? We've talked about this before. Every decade, there's typically two opportunities and two big issues that pop up when we're referring to finances. Hopefully when that next big opportunity or issue pops up, you've got capital in a place. I would personally do it here in one of these policies, but at least you have capital somewhere that you can access to kind of weather that storm or seize that opportunity as it comes up.
Right.
Anything else you want to throw in there, Scott?
Yeah, I was just jotting down a couple of things. We talked about like the sequence of money through a policy first. I know a lot of places, more specifically some of the Facebook pages that we see, or social media rather, they'll talk about this being an investment. And I just want to point out that it's not an investment. It's not. I guess the best way to describe it would be like a savings account in a roundabout way. I don't even know if I would describe it as that. It's just a lack of a better term. But your sequence of money through. So like when we say like the sequence of money, you can still do the stuff that you're already doing, and this is going to help you do it more the longer it's in force, because the cash value and such is going to grow. The policy's cash value is going to continuously grow. Sometime it's going to get to the point where $1 per dollar you're putting premium in, you're getting $1 back. And then on a juvenile policy, heck, it can grow tenfold. Dollar premium in, 40 years from now can be $10, $15 in cash value.
40.
But
40,
getting back to just like a regular...
Start a newborn policy, you can get 40.
Yeah.
At 65. $1 goes in, they get 40 in dividend. Unbelievable. Compound growth.
It's wild. But going back to like an adult policy, if he's in the beginning, yeah, you're going to put premium in, you're going to put let's just call it $10,000 of premium. You're not going to have all that available for cash value. So you might only be able to say you're a brokerage person, you might only be able to put half of that into your brokerage, but you can do that. And then when it comes to the policy loan, a lot of times we get the kickback on the kickbacks around where we get the kind of using like farming. You get the blowback of like the whole interest argument on the policy loan. And it's like, well, it is a business. Think of it as buying gas at your own gas station. You're gonna pay $3.50 a gallon at the pump to pump your own gas in your vehicle. So it makes sense if you're looking at it from a business standpoint. Who's the safest borrower for the insurance company to make money on the policy to help pay that dividend? And that would be the policy owner. So, we have to pay the secretary to do the paperwork. We have to pay the accountant. We have to pay, there's people there that need to get paid to run this business. So the policy loan helps run the business. It doesn't increase your cash value. So you're not getting it, but you're not getting all the money for the $3.50 a gallon. I think we use the, stealing the peas in the grocery store in the book as the example. You're not going to make that money back. But if you took that can of peas off the shelf and didn't pay yourself the full cost of it, now you got to do it 20 times over. I think that Nelson points out in the book. Like it's a lot of times over that you'd have to sell that same can of peas to recoup that loss. So you can't. You got to play an honest business person with this. But those are the two things that I always see is people call it an investment. It's not. In the long term, it's going to help you do your investments if that's who you are. And policy loans, they won't increase your cash value, like Andy said, but they do keep the doors open and the wheels turning on the bus. And that's what you need for all this to work smoothly.
I think, yeah, I like what you're saying there, the investment versus the savings. That's huge. I think that's pretty easy. If I can add a little bit on the loan side, I think we should probably do a separate podcast on it, but just to clear it up, when somebody's taking loans, I kind of think about it in two ways. If they're comparing it to a conventional loan, I think most people understand that because you're either going to be paying back the loan to the bank or to yourself. The nice thing is if you're paying it back to yourself, your cash value is being replenished, but also that entire time you're getting dividends on that money as if you never took the loan. So I think for most people, they're able to understand that. I think where people sometimes get a little bit lost is if they just pay cash and don't have the loan to pay back. And so that really comes down to opportunity cost. And so if you pay cash for something, all you have is the asset. In this case, if you pay for that item, whatever it is, and you use a loan, not only do you have the asset, but as you pay back, you're going to have immediate access to that cash value and you're getting the dividends the entire time in the background. And in the beginning, short term, and Nelson talks about it when you compare this to a CD or something like that, you will be slightly ahead if you use a CD versus this. We're not going to try and argue that. You just need to think long term. And where this really starts kicking in, and we hit on it with the juvenile policies, or, Scott, you were talking about when you're putting $1 in, you're getting more dollars back, even for older policies. That does happen depending on how we structure them fairly quickly. What's going to happen is you're going to have access to far more cash value than what that loan ever was for that asset. So that long term growth is really where these things start making it. And so, we've said it before, if you have a short-term only mindset, this is not for you. It's not even worth getting into it. But if you can pivot and get to that long-term mindset, you are going to be so far ahead of your peers. It's going to be incredible. But it just takes a little bit of time to get going. That's the most difficult thing with all of IBC, in fact.
Yep. Completely agree with that. And, you brought up cash flow from a business standpoint. If you can see things through the lens of cash flow, it really helps make these unlock and understand a lot better as well. If there's a human element that gets talked about in the book in terms of, are you a paycheck to paycheck type of person? That's usually a human element type of a thing. So, did you need that fancy car to impress, someone else, or was it really for you? Did you need all these other things? So, we could do a whole nother podcast on the human element as well. But there's from the mindset of cash flow, if that's not in a cash positive or a cash flow positive coming in and out of your household, it's not going to work on a setup either as well. So there's a lot of those conversations typically happen as we, try to, peel some of the layers back and understand where you are and what you're doing and how that works. So it requires, being open and honest with your practitioner and just understanding here's where I'm at and here's what I'm looking at. And then if we can, determine that the cash flow is positive, it becomes pretty easy to set up.
Yeah, so this is, we're focusing on premium in this podcast, but we're delving into a few other things that I think do kind of tend to get into this as well, because people sometimes are considering premium, they're looking at alternate ways that they can spend their money. So I think it's worth hitting on these as well. And I don't want to go into it now because it would be here for another half hour or longer. but I'm going to post 3 different articles from Carlos Lara, and they're Carlos Lara on his take on an IBC tax strategy for a business. And really, it's premium related. And what he shows is if you look at that cash flow and use it to premium first, and then use that cash value that it develops to go pay your taxes and replenish it, it shows just how powerful this can be. So I will post a link on that. I'll give a quick summary as well in the notes. And so if somebody wants to dive into that, I think that could be useful for them. But I thought it would be worthwhile as well is it's one thing for us to kind of talk about what's going on, but I think if we can talk about how we've been using it and the premiums that we pay, we don't have to get into exact numbers, but just kind of what's going on. So I'll start it off. Personally, I've been paying 6 figures long before I was ever a practitioner, so wasn't getting commissions, anything like that. It wasn't until I actually saw the power of what was actually going on that I decided that I wanted to become a practitioner as well. And it's allowing me to take advantage of opportunities that I could not have done using the modern conventional financial guidance that's out there right now. And it's kind of ironic because practicing this, I'm actually saving more in taxes and increasing my current cash flow operating with the IBC mindset compared to if I would have been doing this with conventional guidance. And I'm still expanding. So I do have a very big convertible term policy, both on myself and my wife. And as things improve and my financial picture gets better because I'm using my cash flow to invest, it's really not consuming at this point. Most of what I'm doing now is actually investing. And as I pay back that loan and I have that delta, I'm using that delta then to expand my policies is really what I'm doing. And the big thing is I want to get more of my capital into the policy to increase that death benefit is what I'm talking about there. And ultimately, that's going to give me even more cash value to then go to the next investment as well. And before we even were talking, I mentioned to you guys that one of these things that I'm doing, I'm starting off on a new venture. And unfortunately, I've not been in this for 20 years. And so I have not been able to slay all the snakes and dragons. So I still do have to rely on some outside finance at this point. But it was really cool because on one of the intake forms for this outside finance, it actually asked me how much cash value I had in life insurance. And the number is respectable, I think, from where I'm at right now. But I thought it was pretty cool that somebody else was seeing the value there.
I just finally got to the point where I'm using cash value for investments as well. There's a meaningful amount in the cash value portion, and as opportunities come along, it's been really nice. The last 6 months have been actually pretty exciting. Starting to use what's there and what I've been unknowingly for the first policies. Like I said, I've had policies for a while. It's just didn't really know what I had until maybe about 2 years ago, but like the last 6 months have been pretty exciting. I've heard it in other podcasts as well as when you have capital, opportunity will find you, and it's incredibly true. Meeting tomorrow with a guy out in New York before I start work. We're gonna talk about other opportunities that are out there and see what else is there, and see if it's a right fit or not, and then just more so just catching up. But that's one of the things. He's an IBC guy as well, so. We'll see where that leads to. Might have more opportunity coming, but then it goes back to premium being the solution. So, and I look forward to the next expansion. So, that's expanding the system is just almost as much. There's almost as much excitement there as there is just using the system.
Yeah.
Yeah, for us, we started a couple of years back, and for us, it was a conversion of our I call it my oh shit fund. When my account that was just sitting there gaining whatever a couple of percentage points of high yield savings was getting, when I finally realized how worthless that was to have it sitting there, it was liquid to do exactly what it was needed for, was a oh crap fund. This replaced that. So to think about what was used to fund our first policy, it's pretty crazy in terms of the amount that went into it. But that's been there now as a backup point for our family for years. And as it grows, and the litmus test that I like to offer is if your premium is paid up, your loans are paid off, and you're growing money in someone else's bank, it's time to consider expanding your system. And so we've done that. I'm in a really kind of unfortunate scenario where I'm uninsurable. We've talked about that in other webinars. We can go down that path some other time if you'd like to. I'm happy to share, open book on why I'm uninsurable. But that made it so we had to get creative. I had to get a really large policy on the missus. Well, that ends up getting limited because she doesn't work. That gets limited to half of what I'm protected to. So you get a human life value that you start to creep up on limiting. So we have to be really careful and cautious to not just burn through a whole bunch of term policies to allow us to crank more PUAs in there. Again, there's a whole structure discussion you could have on that as well. But because we're limited on the human life value and what we can do for our family, we've got a real big policy on the misses and then multiple policies on the kiddos. Again, it's constantly expanding the system. As that that litmus test passes, we go consider another policy and what that looks like. But we started at a spot that was very meaningful by what went in, but also very manageable. So it's just, kind of practicing what you preach type of a setup. In terms of how we've used it, I've financed multiple vehicles in our family. We've taken over escrow accounts. So rather than pay taxes and insurance through an escrow to the bank, I take on those, and I have no idea what percentage point they're making on my money that comes in, but I know they're making something. Now I do that. I take it through at the end of the year. I take a loan from our, cash value, send it right off to the insurance and the taxes, and then I pay it back over the course of 10 months. And then I got 2 months over the next, before the other year starts, where it's just sitting there ready to deploy. So there's so many different ways that you can use this. We've dabbled a little bit in the investment side as well. You obviously, just as you guys have both done, you've got to be careful to make sure that you're not having to come out of pocket or you get caught, in a bad spot where, the investment that you made loses value. The return of capital is more than important than the return on capital. You've got to take that kind of a mindset with it. But with all that in mind, to have that control and to be in control of all of that for, my family has been amazing. What it's unlocked has been absolutely unreal.
Yeah, one thing I want to circle back on, it was really good. I like your emergency fund there. And most people I don't think realize this, but you put the capital or whatever you have somewhere else into one of these policies, in about 2 weeks you have access to it. And the other big thing is we can structure these so that you have access to a significant amount of that capital as well. Depending on how we do it, usually it's about 92% in that first year when you put it in, and it's just going to grow. And that's that 8% is a really small delta initially. It's just a short you lose a little bit of liquidity for huge gains in the long run, is what I'm getting at there. And so, if that cash or capital now is in your system, it's working for you versus that outside bank where, you're either waiting for that opportunity or unexpected event that's popping up.
Yeah. And if you do look at, when you talk to your practitioner and you're getting onto a spot where you're looking at what that might look like, do you want, 80% excess, 85, 92? If you go the 92 route, you might end up losing in some long-term gains, right? Like this is a long-term thinking type of a mentality, but we custom make it for what your situation is. If it's so important right now that you get 92%, hey, let's talk about it. Let's see, are you aware of what you might be giving up long-term by having a little bit more into a base premium? Yep, I'm aware of that. Cool, let's run. So we want to be able to have that conversation and not have you educated via some crappy YouTube video.
Jared, that's great. I want to make sure I clarify there because I could have been misleading there. That 92%, I'm talking about a small portion of your overall premium going to that 92% available. Yep. I would by no means recommend that 92% of all the premium going in would be available. It's just a small rider that we would put on there. So I want to make sure that is cleared because all premium could be different, but that's spot on because somebody might be listening to this and all of a sudden take the wrong thing from what I'm trying to say there.
Totally get it.
Perfect.
Yep.
Cool. All right. Before we go, anything you guys want to add?
Best time of year is pay premium. It's cut and dry.
All right. If anybody out there has anything that they'd like us to cover, don't be shy. Go ahead and let us know, and we'll see you on the next episode. Thanks for tuning into The Infinite Mindset. If you found today's conversation valuable, share it with someone who's ready to think differently about finances. And don't forget to subscribe. Your journey to financial freedom starts with the right mindset.